At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
I've got a PowerPoint or a few slides that may help people understand what fractional reserve lending is and really how this works. So I'll just go ahead and share this and really talk about some of this stuff. So there's our pretty pictures. But let's just dive into this. This is RBC, and it's not their obviously complete consolidated financial statements. It's not their full financial report. That's 288 pages, which is really difficult to share on a screen. But I want to kind of pick out a couple of points out of that and kind of bring it to light. So you'll see here that there's three different types. This is the deposits listed as millions of Canadian dollars. So that number here is 510 billion. Okay, so demand deposits are things like your checking accounts, your savings accounts, basically any different type of checking or savings account. There's banks that have deposits with Royal Bank. There's governments and businesses that have deposits at Royal Bank, and there's people just in their regular checking and savings. There's $182 billion on deposit and checking and savings accounts at the Royal Bank. And you can multiply this by the big five and all the credit unions and all that in order to get your total deposits. Notice deposits are slightly different. They are demand deposits that are maybe temporarily locked in, and you need notice to withdraw. So the client wants to come in and withdraw some of those monies. Well, they have to give the Royal Bank notice on that. And term deposits are time deposits. So total of $421 billion in deposits in this example, which is 1 to 5 year, maybe even if they've got longer than 5 year term deposits. I know we used to have a 7-year term deposit, but let's just say, for example, that these are just 1 to 5 year terms. You lock it in, and I want to very clearly establish that this term deposit is the Medici style of banking. So the banks collect this money and need other people's money in order to lend that money out. Okay, and we're going to get into how much money they've lent out on that. But what Dr. Murphy really explained to me is that the difference between lending out your checking and savings and maybe even your RSP, because RSP cash balances are in that demand part, that is this total amount between the 510 billion and some of the 79 billion is what the deposit bankers have lent out, and we'll be able to show that. Now they need to keep 10% back. They can't lend out everything, but if you think about it, as you expand the money supply from lending out more and more money, what happens is that more and more deposits come on. And then as you have more deposits, those deposits get lent out and those deposits get lent out and so on. So as an example, we've got the average Canadian. Now I've got JP Morgan there in the middle. But if they are depositing at, say, if they're lucky getting 1% today and they're lending it out at maybe 2-3%, I think the 5-year fixed rate mortgages right now are at about 2.99 for a 5-year fixed with Royal Bank. But let's just say that there's a lot of people in variable rate mortgages, and you've got higher rate mortgages with commercial loans and car loans and all that sort of stuff. But let's just say, for example, that their deposit rates, the cost of those funds are 1%, and they are lending it out at 2%. Well, of course, there's going to be a real rate of return, which is 100%. And that's the difference between 1% and 2%, right? Most people think it's 1%, but no, it's 100%.
I was just going to say that. I was going to say that the tempting thing is to look at that and say, hey, that's a 1% return, but it's a 1% difference. But you're right, that's 100% return, and that's on one lender.
Correct.
Right? Borrower, I should say. So wow.
Yeah, and one institution. So multiply this right across the system, and this is why people are like, well, I don't understand with the compression of rates and the spread on rates between what they're lending out and what they're paying out. Well, guess what? It's volume. The more they lend out, the more they get to multiply this. So imagine now you've got this depositor and he's taking that loan at 2%. Now that guy with the loan, he's going to maybe buy a motorcycle or buy a car or do something. And now whoever's selling him that thing is going to have that. And they become this guy, right? Now they become the depositor and they go to their bank. Maybe it's TD or BMO or whoever. And they deposit at 1% or less. You know, if it's in a checking account, I don't know if anybody's looked at what their annual interest rate is that they're earning on a checking account, but regardless. And this is the problem, is that when you're putting it into a checking or savings account, you're getting paid 0.1%. So the profit margin is now multiplied. And the question that most people have is, well, how do they lend out when they still owe that to me? And this is the problem. The fractional reserve lending, they're betting that you will not take out all your money at once. And this is why the Bank of Canada, the US Federal Reserve, part of their job in the overall environment, financial environment or economic environment, is to be the lender of last resort to banks. So banks have to keep 10% of their money in what's called a reserve. Okay. In Canada, we call it liquidity requirements. In the US, they call it a reserve requirement. But it's all based on the legislation or the regulations that are international, based on the Basel III regulations that were reset in 2009 or 10 after the financial crisis. So, you know, all the international banking guidelines are the same. So people say, oh, well, our banks are better. Really? Can you explain that? Or is that just a belief system that you have? Because we are about as strong as the banks in the States from how much they can lend out of the money that they have on deposit, plus the bail-in legislation, which was passed in 2016, first year of the Liberal government. And it wasn't the Liberals that proposed it, it was the Conservatives that proposed it. But basically, instead of providing bailouts to banks, they're going to take the depositors' money and use that as liquidity. And you're going to get transferred. In the event of a bank failure, you're going to have your money turned into poof. It's going to become shares in the bank. And you no longer have that money. You can redeem it maybe, but who's buying shares of a bank that's who's buying shares of a bank that's gone bankrupt? So they're going to capitalize on your deposits. Problem number 3 is that the Canadian Deposit Insurance Corporation, CDIC, who insures more than $850 billion of Canadian bank deposits, only has about $5 billion in cash. That if a major bank went under, as unlikely as this a scenario that may be, if they go under, there's no money. They have an additional $15 billion of special drawing rights against the government, but that's only $20 billion. And if we have a major catastrophe, which again, as unlikely as that scenario may be, Canadian depositors are going to feel pretty short-changed, I think, based on the first $100,000 that they have on deposit in their accounts. So now let's fast forward here, and now let's relook at the ability to lend out on that. You see here that there's $510 billion plus this 80 in short-term deposits, $421 billion in term deposits, and so the total deposits is about $1 trillion, and there's about $1 trillion listed in all these amounts here that the Royal Bank has invested in. Now, I'm not even going to cover the derivatives that they own and the other securities that they have. This is just pure cash loans that are in and out, and why banking is the most profitable place, because most people don't realize that their money, as they're sitting on it, is being lent out, right? And you and I talked about the opportunity cost before, Glenn, but this is a whole new level of understanding for people that really want to know, kind of peel the curtain back behind banking. And I like the analogy of somebody recently was saying, this is where we are in society, is that they pulled back the curtain of Oz and they can now see the Wizard of Oz at his little control panel trying to figure things out. So now let's relook at this in terms of the total amount here. Well, 421 billion. Well, it's way more than 4 billion that they've got lent out, and a deposit and checking. That's actually about the whole thing. They've lent out on $1 trillion. They've basically lent out $900 billion, right? And going back here, that's on this amount here, right? This is deposit banking, or this is loan banking, this is deposit banking. And now we can see, what happens is the expansion of money through a fractional reserve system, the impact that it has in the economy is how individual deposit holders at a bank participate in the financial destruction of the value of a dollar. So it's just an unbelievable problem that people don't even recognize. And every time that the Bank of Canada backs up another deposit, or they do a repo where they're buying short-term bonds basically from the banks, they're maybe doing a mortgage swap or something like that. That also gives more liquidity to the bankers to turn debts into assets and turn assets into more loans, and more loans equals more profit, 9 times that profit.
Wow, so it's just one circle keeps going round and round and round.
100%.
Wow, that's amazing. As you said a little bit earlier, they get the deposits in, the more they loan out, the more deposits they get in, the more they can continue that cycle.
Yeah.
Right. So wow. So what do we do about something like this, Mike?
Well, I think Carlos Lara and Bob Murphy and Nelson Nash, who wrote the book, The Case for IBC, pointed out, and really how privatized banking really works, which was really the magnum opus for Carlos and Bob. It's a very heavy book to read from an economic standpoint. It'll probably go over most people's heads, but in that book, they really hammer into the solution of getting your money out of the bank. And there's a wonderful word that I like using all the time, and it's called hegemony. And that basically means is that when banks try to say that they're the only place that you can bank, they've got this monopoly, a cartel on banking. That's not true. That's not the case. They are not always in charge. They're in charge of the money supply, certainly by the look of this graph here, but you can actually exit the banking system, get your money out of that fractional reserve lending system and put it into something that is 100% reserve. And this goes right back to the beginning of my history lesson, which was the Medicis were doing legitimate banking when they were acting as a facilitator between depositor and borrower, and entering in, helping broker a deal for a loan that was actually doing something, but they weren't multiplying. They weren't taking the proceeds of that and doing it again. So that's the big thing that Carlos and Bob, and again, in their book, How Privatized Banking Really Works, really goes through how to exit the banking system and take the sovereignty back of your money. And if more and more people did it, we can actually create a ripple effect, and maybe we can get back to sane money principles, sound money principles. that these guys talk about in their books. Becoming Your Own Banker, How Privatized Banking Really Works, and the Case for IBC.
IBCanada Group, your independent authority for information on the infinite banking concept.